Hello investors, this is Gary Luna. This is Grant Haddon. Adam Carlini also is with us. We are Dynamic Wealth Management, and this is our Wednesday, January 20th update. A lot of things going on in the market right now. This market is having a tough time getting going. We've had a very difficult year so far. Already the market is down by 9%, from top to bottom down 14%.
Yeah, we changed our allocation about a week and a half ago on January 11th. We went completely defensive that day. So with that being said, let's jump into the charts and show you how that decision panned out.
Okay folks, good to be with you. Let's go ahead and jump into things. Before we give you a market update, let's talk about some upcoming events in case you want to come and see us, get to know who we are, find out what we do. Again, we do an informal gathering and also formal seminars. The informal, investment for breakfast, we do them every Tuesday, every other Tuesday. We just had one this week. The next time we meet will be February 2nd, and that is here in our office at 9 o'clock in our conference room. And we talk about what's going on in the market, the economy, interest rates. We give some good ideas as far as strategy. The next time we meet after that will be February 16th. And we also do formal seminars, which we actually, this is a dinner seminar, nighttime seminar, January 28th here in Sun City Grand. And we'd love to have you out for any of those events. Give us a call, let us know you're coming out, and we'd love to meet you, get to know you. Let's talk about our main risk indicator, and this really sums up kind of our view of what's going on in the marketplace. As if you've been watching us over the last few weeks, you know that we have moved from the green zone into the yellow and quickly into the red zone. In fact, we have been in the red zone since January 11th, so about a week and a half now, and the market has moved down another 3 or 4% since that point in time. What does that mean? It basically means that we are defensive on our allocations. We have completely gotten out of the risky side of the market and into the more defensive side of the market all across the board. It doesn't matter what risk profile our clients are in. We'll continue to stay in that zone until the market settles down, moves back up, and we create hopefully another trend. But we will be patient and let the market indicate when the best time to do that is. We hope that if you don't follow our plan, that you do have a plan on your own, because this market can get uglier before it gets better. Let's get into the economy and give you a couple quick things. First thing is we're continuing to now see some weakness in the U.S. economy. So what we're finding is not just China or other parts in the world are having a tough time, but the U.S. economy is now starting to get even more sluggish. Here's further proof of that. This came out this morning, the Philadelphia Fed Business Outlook Survey, which surveys the manufacturing sector. As you can see, as you look at the chart going back for the last 2-3 years, that is continuing to show weakness within the manufacturing sector. Obviously that is not a good thing. With weakness globally and here in the U.S., what is the Fed looking at doing? Remember, they talked about raising rates about 4 times, about 1 percentage points higher in 2016. Well, the recent bad news is probably giving them some reason to pause. So the next time they meet will be January 27th, and now there's only about an 8% chance that they will raise rates another 1/4 point. The next time they meet is March 16th, and the markets are tacking on a probability of about 37% that they will raise rates at that meeting, but that has also diminished in the recent weeks as more bad news and the markets have begun to tumble here. Speaking of the markets, let's go and turn things over to Grant so he can walk you through the charts.
All right, Gary did a great job walking us through the economy. Now let's talk about how that has affected the stock market. So here is a snapshot of all the major indices year to date in 2016. We're going to start with the S&P 500, down about 9%. Developed countries, down about 11%, 10.5%. Emerging markets, down 12%. REITs, real estate investment trusts, they're down about 7%. High yield bonds, down about 5%. And commodities, if you've been watching them for a while, they're pretty much always down 11% year to date, and they've been down for the last few years. Gold is up. Now that's something new, right? That's showing us that when the market gets a little scared, people do tend to run to gold a little bit, and that's happening this year. And also treasuries, especially long-term treasuries, have been running up good this year. So what that tells us is that this is not a risk-on environment. All these risk-on assets here are down, and the things that are up are more on the defensive side. So it's showing us people are more interested in being defensive this year and not in buying and holding risky assets. All right, here's the S&P 500. Now, this was that big giant drop, right, back in August. And we thought that might be the beginning of a big drop here, but that came down, stopped at about this 1867 level, ran back up to 2020, came back down to 1870, pretty much right, hit on this line again, popped back up, and look where we are now. Came down, and we've had a couple of days go beneath this and come back up and get right down to it, come back up. Today it broke through it with authority, really came down huge, but made a strong rally back. Look where it stopped this time. This is the first time that a day has closed beneath this line. To us, that is telling. We might get a little pop here, but it's telling that we are continually making lower lows coming down here. So we are concerned, but we're happy with where our allocation is. We are in treasuries and bonds and all defensive assets at this point. So if the market continues to go down, we should be in a good position. Now, here's the last 5 trading days. So we'll just show you. Here's that same exact line we were just talking about. It's just much more zoomed in now. So market comes down, gets close to it, goes back up, and then look, it comes down, gets close to it, comes back up. Here it actually breaks through, it kind of dances along that line, comes down, holds it, and then wow, here's today. Down, strong, far beneath the line. Look at the rally, comes all the way back, it's above the line, just to turn and fall back under it and finish right underneath the line again. So tomorrow's a big day. It's a big inflection day for us to be watching. Here is oil prices. We all know oil has continually come down. As other countries inflate their currencies, the dollar becomes stronger. As the dollar becomes stronger, that puts pressure on commodities, puts pressure on the price per barrel of oil, and it continues to come down. Look at this, all the way down to $28.35 per barrel, when just recently we were up at 107, right? That's a wild drop in oil. And a lot of the experts are not saying they expect it to come back to a level like this anytime soon. So what are we doing? Well, I think we already pointed it out to you, but remember, we change our allocation based on where we fall beneath these lines, and we are beneath the red line here. We were beneath the red line all last week, and we're even further beneath now. So we changed our allocation, and our allocation is the same for no matter if you're a growth client, a moderate client, or a conservative client. You'll notice all of our clients have no risk on assets, and they haven't for a week and a half now. And they are 100% in defensive assets. What are defensive assets? Well, treasuries, some high quality bonds, things that are going to protect us and have actually made money as this market has fallen apart, as opposed to lose money. With that being said, we want to thank you so much for watching our video. Here's our disclosure. This is in no way a recommendation to buy or sell anything. You should always consult a financial professional before you make any financial decisions. Past performance is no guarantee of future results. We appreciate you watching our video, and we hope that you'll be able to watch our video again next week. If you have any feedback, please respond to the email that you received and let us know what we can do to improve this video. Thank you. We'll see you soon.